DFMs resist urge to go gung-ho as coronavirus and oil price war jolt markets following a day that saw the FTSE 100 close down 7.7% and the two-year gilt yield plunge into negative territory for the first time. Multi-asset managers are selectively adding risk rather than going gung-ho. Global stock markets plummeted on Monday after the Kingdom of Saudi Arabia triggered an oil price war by slashing the official selling price per barrel and vowing to increase exports by up to 800,000 barrels a day. This, coupled with the rapid spread of the coronavirus, led investors to flee risk assets and seek safe havens such as sovereign bonds and gold.A. 7% fall in the S&P 500 in early trading led to a circuit breaker being applied which saw dealing suspended for 15 minutes. The FTSE 100 closed down 7.7% while the Eurostoxx 600 closed down 7.4%. The two-year gilt yield fell to as low as -0.04% while the 10-year yield dropped to an all-time low of 0.08%. In the US, the yield on 10-year US Treasuries hit a new low of 0.318%. Stocks have not necessarily become cheaper. In an update for clients, Psigma Investment Management Chief Investment Officer Tom Becket, pictured, said while buying the dip is a common strategy, it was unclear whether stocks have become cheaper as the coronavirus continues to spread. He said this is because of three reasons. First, the ongoing reduction to corporate earnings growth means that valuations might not be as cheap as one might expect as the E in the PE calculation has fallen. Indeed, you could easily make the case that equities have become more expensive on a PE basis as you must adjust the earnings denominator, said Becket.Second. He said stock prices are simply falling from all-time highs to levels more realistic from a long-term valuation perspective. Finally, the falls have not been as extreme as they might have been given the potential economic impact and the possible damage to corporate profits. Certainly, we haven't seen the purging of the excesses of en vogue investments like the technology sector yet, although it started to underperform last week, but were that to happen we would start to consider a buying opportunity as being presented. Selectively adding credit risk. Becket said Psigma's attention has been focused on its credit allocations with a small number of managers. We know exactly what we own within funds, why we own such instruments and how they are performing, he said. Having had calls with each manager last weekend and late the week before last, we have had follow-up conversations in the last few days. So far, the performance of the credit investments has been as we would have expected. Given some of the funds were defensively positioned heading into this year, we have been in discussions with the managers to selectively add risk to portfolios, as yields have become more attractive. This is not a case of buy. For more on this story, visit the news article link.